Okay, this will be a video kind of, response to Emendem Jr., who calls himself anti-bullshit man. He's anti-bullshit. He's against bullshit. Okay, Emendem Jr. And I didn't watch Emendem Jr. video. It was 30 minutes long. I'm not going to watch that crap. But I did see throughout the video he had a lot of sources in the description. They were all little pictures. They're all pictures to these charts that he had. And so then I scrolled through his video a little bit, see the images in the video, and I basically know what he said in the video. I mean, come on, like he's not going to have an original idea or original argument. So I don't think I have anything to worry about. Presuming what he said in the video. In the video, he said that income taxes were high in the 1950s or something. Income taxes were really high. The top marginal tax rate in the 1950s was like 90% or something, and it scaled down. It was progressive, so it scaled down a little bit from there. And what he showed is that look, the top marginal income tax rate and the corresponding other brackets are falling all throughout this time period. Okay, and then showing how on another line that income was not increasing as income tax fall, or wage growth or hourly wage growth, and one with unemployment, how unemployment was like growing, or there was no correlation, or whatever it is he said. Basically saying that lower taxes does not result in greater economic growth, or perhaps even the reverse, whatever the chart said. First problem with this argument is that it ignores historical context. What you'll get is a lot of these shit-eater, Americanist, union, labor, national socialist types talking about how, well, in the 1950s, 80% of people were in unions or something. Let's say a huge percentage of people were in unions. We had the Teamsters and the trucking industry, and we had the airline industry, and the mail was all state-run. There was no privatization of mail. And things were great back then. Things were great back then. And why can't we go back to that? Why can't we go back to that? And my answer to why we can't go back to that, there's quite a few reasons why we can't go back to that. One is Japan, China, Korea, India, rebuilt Germany, rebuilt and unified Germany, Italy, France, rebuilt Europe basically, Brazil, Mexico. Lots of reasons why we can't go back to that is because the U.S. is actually competing with other areas around the world. Following World War II, Europe was destroyed. The Soviet Union sucked up a huge portion of the globe and basically made that area non-competitive. The Arab world has not come along. Africa's Africa. South America had not really developed yet. Southeast Asia was, somewhat ravaged by war, but Southeast Asia really hadn't come online. Japan was ravaged by war. China was ravaged by war, but communist anyway, so they weren't going to compete anyway. India was still, doing that whole little social democracy thing with the Raj, and so their economy was stagnant. So really, the U.S. was the only game in town, and in this environment, basically anything could have been done, and there would have been a great deal of prosperity. Or just about anything could have been done, and there would have been a great deal of prosperity. But the more important argument to be made is that the tax rate was not really that high in the 1950s. I don't have charts on hand or anything, or even a source I can link to right now. But if you look at government spending as a percentage of GDP, what you'll see in that is that in the 1950s it was much lower than it was in 2000, and definitely much lower than it is today. And what this means, because government spending is lower, that means that taxes are lower. Now, how do I explain this? Let's say government taxes at, through property taxes, income taxes, whatever, it sucks out 20% of GDP. And then spends 40% of GDP on a whole bunch of stuff. How is it spending all this money on a whole bunch of stuff? Well, basically they're printing money. They're buying bonds. Well, how are they? They're selling bonds. And in the long run, what this does is this ends up expanding. They end up putting out more dollars than came in from the bonds. And so what they have to do is they have to create money basically out of thin air from the Federal Reserve. And so what this does is this expands the money supply. And so there's more dollars floating around, more dollars chasing a certain amount of goods. And so what does this result in? This results in inflation. And that is the tax that occurs when the state deficit spends. When the state deficit spends, you get the inflation tax. All government spending is paid for by some sort of tax, be it a property tax, sales tax, income tax, or inflation tax. So when Ronald Reagan had massive increases in spending and cut taxes, well, or cut taxes, so he said, he wasn't really cutting taxes. He was cutting the income tax and increasing the inflation tax. So that's one thing to keep in mind. Another thing to keep in mind, when you have a top marginal tax rate at 90%, I mean, the rich and the famous are not going to be paying at that. What they're going to be doing is they're going to be doing a lot of financial trickery. The CEOs are going to basically, oh, well, this is not my house. This is my company's house. My company owns this house. It's a business expense, you see. This is not my yacht. This is a company yacht. Okay, so all of a sudden, wow, these companies, they sure own a lot of yachts and nice houses. Oh, didn't know that was a cost of doing business. And so you get that bullshit in a 90% tax rate environment, and you have to, because if you had that tax rate and you had that actually being enforced, then there would be no real incentive to become a head planner of an emergent structure of production. And so we would have a shortage of basically higher ups. We would have a shortage of uber capitalists. Uber capitalists who like Standard Oil, which resulted in the price of oil dropping like 3 or 4 times over like 30 years or something. Some ridiculous reduction in the price of oil and the price of petroleum products through the new refining techniques and the new exploratory techniques. I mean, you wouldn't have these things in such a high tax environment if the taxes were actually enforced, which they were not. Super rich found ways to get around it. Anything else that can be said? Yeah. So basically, this stuff about like the income taxes went down, and jobs did not increase, wages did not increase. Well, the reason that is because taxes didn't really go down. What went down is a certain form of tax with an increase in the inflation tax. Moreover, well, I'll just stop right there. I also saw in the video, or saw in the description there was something talking about Reagan deregulating the banks. Deregulation, or deregulating them. Now, first off, I know for a fact, prior to the S&L crisis in 1982, I think, don't quote me on that, there was an act that was passed in 1980 which upped the bailout guarantee for each account from $40,000 to $100,000. And so banks had, when you go to a bank account, you open a bank account in a bank, you have a certain bailout guarantee. It's called the FDIC, Deposit Insurance Guarantee. It's a bailout guarantee. The bank is not liable if they go under, because they know the state, i.e. you and people who did not invest in that bank, are going to bail them out. And so when you increase the bailout guarantee from $40,000 to $100,000 per account, what's the bank going to do? Well, they're going to take more risky investments. They have more guarding their back. They're the more than double increase of the bailout guarantee. But so what they're going to do is they're going to engage in a lot more investments, and in an environment of an artificial boom, what that is going to result is that's going to result in a huge increase in the wages for people at financial institutions. Another thing to keep in mind is that we're living in a completely phony economy in terms of credit. What happens is the Federal Reserve centrally plans the price of money. Basically, it's basically a price control. And so what the Federal Reserve does is they decide what they want the target interest rate to be, and what they'll do is they'll loan funds out to banks. And they'll say they'll loan to certain privileged banks at 2.5%. The banks then loan to you at 3%. You can't go to the Federal Reserve and get these 2.5% loans. No, they loan to the banks at 2.5%, and the banks then loan to you at 3%. So it's pretty hard to lose a whole lot of money in that kind of scheme, unless you're criminally incompetent, which, well. And so they have this system, They're getting money at 2.5%. Just, almost like an unlimited amount. Not an unlimited amount, but a whole lot of money at 2.5%. And they can loan it out at 3% all day. And if it gets paid back, well, it's like a guaranteed money-making scheme. So, yeah, of course there profits, and I don't know what you were talking about. You were talking about wages or whatever. But anyway, the income that these institutions are going to get from that scheme are going to be really high. And when you have that combined with a bailout guarantee, combined with a bailout guarantee is going to cause these banks to, invest like crazy. What had been stopping this was a state-imposed regulation that counterbalanced the effects of state-imposed, madness, state-imposed, pumping money into the banks and bailout guarantees that would spur the banks on to make all sorts of risky loans and stuff. And so these regulations were good because they were a response to the irresponsibility of the state at one end. So basically you had the state spurring them on at one end and then putting on the brakes at the other end. The state was spurring them on, bailout guarantees, special right from the Federal Reserve, and you can't make certain types of loans. You can't make these types of loans from certain people. You can't make money market loans or something like that. So you had spur on at one end and brakes at another end. So what did Ronald Reagan do? Well, ideally, what should have been done is you remove you abolish the Federal Reserve, but you remove the spurring on at one end and you remove the braking at the other end. What did Reagan do? He just removed the braking. In fact, he increased the spurring on by increasing the bailout guarantee. So what did you get? Well, you got a massive overinvestment, and the overinvestment, of course, failed. You had the boom and bust cycle. Should I talk about the business cycle? Yeah, I'll talk about the business cycle. Okay, let's say you want to build a wall, and you want to build a wall that's 100 yards long. And you only have so many bricks. In reality, you have enough bricks to build a 3-foot-high wall, 100 yards long. And so you set out to work, but then you rely on some bean counter to tell you how many bricks you really have. He says, "Oh, you have enough bricks to build a 6-foot-high wall, 100 yards long." And you look at that and go, "Oh, wow! Well, I'm going to start building a 6-foot-high wall because I know I have that many bricks, so I can build this 6-foot-high wall 100 yards long." And so you start working that way, right? But as you start working, that you start looking, hey, that brick pile is decreasing in size a lot faster than it should. And as you get part of the way through the wall, you realize, holy shit, I don't really have that many bricks. And so what do you have to do? Well, you have to bust bricks in order to cobble together the rest of the wall, perhaps making it a little bit shorter, not all the way through, or all the way through. A similar thing happens when the Federal Reserve artificially expands the money supply. Because let's say you invest in a bank. Okay, what you are doing is you are providing resources to an economy at large through a service or through producing something. You are providing resources to an economy, and you provide resources and you get paid for those resources that you put in. Now, what can you do with this payment? Well, you can go consume, or you can defer your consumption and put the money into a bank, which will then invest into the economy. Now, the money, the little paper that you put into a bank that came from unspent wages, that is actually properly represented by production you have done in the economy. That is, you have done some production, you got $1, and you gave that dollar to a bank, which then loans that out. And so that dollar is properly represented by some resources out there that came from your production, but not consumption. Okay? Now, what happens when the Fed just poofs a bunch of money into existence? Well, what happens is that money that the Fed creates does not correspond to any increase in real resources in the economy. Okay, and so what banks do is they get all this money and they go, ooh, wow, look, I have all this deferred consumption. I have all these bricks, right? And so what do? They start investing in, housing projects, lots of real estate. They start investing in, high fandangled, tech schemes. Like, we have all these resources, and so we can invest in businesses as if there are all these resources in there. Because, of course, if you have more resources, you're going to invest a lot differently than if you don't have that many resources. And just like if you have more bricks, you're going to build a different kind of wall than if you have fewer bricks. Right? So that's what happens. So you have this massive overinvestment boom, massive depletion of bricks, and as, the banks and the investors and whoever's doing the investing is, doing it, they begin to realize, hey, wait a minute. We don't actually have this, there's not really this much stuff in the economy, and all these projects we're undertaking aren't actually profitable. Right? It's a little bit complicated how that works out, but it basically becomes revealed that these projects that would be profitable if there were that many real resources in the economy are not profitable. Just like it would make sense to build a 6-foot-high wall if you had twice as many bricks, but you don't have twice as many bricks. Okay? If you had a lot more deferred consumption, it would make sense to build a giant, hotel in the middle of Las Vegas. Like, hey, we have all this deferred consumption, and people are deferring their consumption so much that they'll be able to afford this. Right? And so it makes sense if you think that the funny money that the Fed is printing actually represents real resources, actually represents bricks, but it doesn't. And so what this results in is artificially expanding credit leads to an overinvestment boom, which then leads to a bust. And this is not just some idle theory. Like, the people who, and there are people who explain this theory in much greater depth. Ludwig von Mises, Friedrich Hayek, von Bauwerk. Okay. These people predict stuff. Okay. In 1929, Ludwig von Mises was actually offered a job at kind of a prestigious bank in Austria. And he actually turned the job down because he said something like, I know that there is a big crash coming. There's a crash coming, and I don't want anything to do with it. I don't want my name associated with it in any way. He said something along those lines. Because he knew a crash was coming, so he turned down a job, much to the chagrin of his fiancée, because it was kind of a high-paying job. But he turned it down because he didn't want to be associated with that crash. And, of course, that year, you had Black Tuesday or in October or something, and there was a big crash. John Maynard Keynes, on the other hand, lost his personal fortune in the U.S. stock market, the British stock market, or something. So, furthermore, I don't know if you've seen the videos or whatever, but the Austrians were the ones predicting the current bust. You had Peter Schiff, going through in great detail about how the bust is happening, how this is all unsustainable, and of course there was a bust. Now, you get a lot of conspiracists who think that, the economy is going to completely collapse or something like that. Well, that's a bit hyperbolic, but there was an artificial boom, and now we're, facing a little bit of the bust, and unemployment is really high. Maybe it's been 3 years now, so some of the bust is starting to clear a little bit, but there was an artificial boom, and there was a bust. So, and the Austrians predicted it, and the Austrians like Ron Paul, Peter Schiff, they were all predicting it back when people like Krugman and Bernanke and what I don't know what mainstream economists are, but basically Krugman and Bernanke were saying everything is fine, everything is fine, everything is fine, like a little like a little record player. Everything is fine. Oh, the housing market may be a little bit oversubscribed, but it's not too bad. Well, Ron Paul was saying a little bit oversubscribed. That's the understatement of the millennium, man. All right. What was I going to say? Yeah. What leads to long-term economic growth is investment in capital, not spending on consumption goods. Because let's just imagine for a moment, let's just imagine you had a whole bunch of people working at factories, a really simplified economy. A bunch of people working at factories producing stuff, and they all go around trading stuff. So they're trading stuff, and at the end of the day, you produce shirts, and you trade your 100 shirts to a whole bunch of people for a hamburger, for, some thing that you need for your car, for some, you produce a whole bunch of shirts and you get a whole bunch of stuff, and everyone produces their own specialty and they trade it for the stuff that they got. Okay, and so at the end of the day, you had massive amounts of consumption. Everyone has a bunch of stuff. Okay, so next day, what do you have? Well, the next day, you have a factory. Next day, you still have the same factory, still the same capital equipment, except that it may be a little bit worn down from usage a little bit. You get some depreciation there. So what actually leads to economic growth? Well, what actually leads to economic growth is investment, right, or savings. And investment comes from savings. As you save money, you put it in the bank then invests it. Or you put it in a mutual fund, or you invest it yourself. That's where you get economic growth. Building new factories, building new implements of production. Now, I'm going to say something here. I'm going to end this on kind of a sour note. Really rich people, as a percentage of the money that they get, especially really super rich people, they tend to invest a very large percentage of the money that they get. And they invest the money that they get, and maybe eventually down the line they'll spend a bunch of money on like institutes and a university or something like that. If you're making $100 billion, if you have like $100 billion, what are you going to spend it on? Like you spend $1 billion and you'll be like, I don't know, what else do I need? Another robotic boat car or something? There's only so much that you can spend if you're really super rich, and so what super rich people end up doing is they end up investing a ton of their money. Also, large corporations, they have high profit rates, but what a lot of people don't realize is that most of the profits that they have are reinvested, or they go out to shareholders, people who are not really, really rich, and they then take the money that they get from dividends, and either they reinvest it, and they reinvest a large portion of it. And so it is money that, and so rich people disproportionately invest. And that is, they invest in more productive equipment. So if you want greater long-term growth, you need to cut the taxes of the people who tend to invest in capital equipment. And the people who tend to invest in capital equipment are the rich, are the really rich. Now, in 1950s America, you had the top income tax rate was really high, but the super rich people were not paying that much in taxes because they weren't reporting it as income. They were writing it off as business expenses. So what that means is that the tax rates on the super duper rich were not really that high, and so they had a lot of money to invest in new capital equipment. Okay. So that's why tax cuts for the rich is sound long-term economic policy. Tax cuts for the rich, the rich per se are not sacred. The rich per se are not sacrosanct. What really matters is tax cuts for people who are going to invest a greater percentage of their income. Or, to really summarize it, tax cuts that will result in greater investment.